Well, hello there. How are you? And welcome to this online lecture where we're going to be looking briefly at accrued and deferred income. I'm Gareth. Well, the example that we're looking at here, we own a building, we're a landlord, we rent space to tenants, these tenants are our customers. We charge them £1,000 per annum, basically a measure of our income. Now we've got a couple of tenants we're dealing with here. One tenant pays for 2 years in advance. So in the first year they're paying us a total of £2,000 to cover the first and second years. We've then got a second tenant and they'll actually be invoiced for that same 2-year period at the end of the second year. So in fact during the first year they haven't paid us a penny. Although even though they haven't paid us a penny, they've still occupied space in our building. We've still delivered them some kind of service. We still need to earn income. And we're going to show the relevant ledger accounts at the end of the first year. And in fact, I'm going to think briefly about the second year as well. Now, let's just think what would happen here if we weren't using accrued and deferred income. Let's imagine we were not applying our accruals concept. Accrued and deferred income is just an example of the accruals concept, just like accrued and prepaid expenses. Now, if we weren't using accrued and deferred income, the double entry here, well, we're receiving cash. Remember, this is income for us. We're a landlord, so this would be rental income for us. Now, for the first tenant, well, they've paid 2 years in advance. So for tenant 1, we would debit the cash account. That's a receipt of an asset from this customer. And we would credit rental income. For the second tenant, well, they haven't paid us a penny yet. So you can imagine we haven't got any cash coming in. We'd perhaps not recognise any income. Now, if you think your accruals concept, we need to recognise the right transaction in the right period. And that's true whether it's income or expenses. Now, we're looking at a 1-year period here. We're interested in the first year. Now, if we've got 2 tenants for the first year, each of those tenants effectively owes us £1,000 for being on that space. Actually, you can see the figures we've got in our rent income account are wrong, because we're recognising £2,000 of income for the first tenant. We're actually recognising 2 years of income for the first tenant. Well, that's not right. We should only recognise 1 year's worth of income. And we're recognising no income at all for the second tenant, just because they haven't been invoiced, they haven't paid us yet, but we still earned the income. So that's wrong as well. We shouldn't be showing 2 years for one and nothing for the other. We should be showing 1 year's income for both of them. So let's start again. We're actually now going to think about how this would operate if we are using 2 further ledger accounts for accrued income. Accrued income is income I've earned but haven't actually been paid for yet. And deferred income, which is the opposite, deferred income, is income I have been paid for but haven't actually earned yet, so I can't recognise yet. Now let's go back to our 2 tenants. Well, the first tenant, now they've still paid me 2 years, so I've still got to debit cash by the full £2,000 they would have paid me. That's gone into my bank account. The thing you've got to understand is I can't show that entire £2,000 as rental income for the period. I can't credit rental income for that £2,000. I should only be showing 1 year's worth of income for this 1 year. So what we actually end up doing is splitting that £2,000. Now, I can put £1,000 to rental income. That's what we've actually earned in the year for the fact that they've occupied space in my building. But we've got to defer the remainder of the payment, the other £1,000. That's effectively income I've received that actually relates to next year, doesn't it? It relates to year 2. So I can't show that in this year's profit and loss account. I can't show that as income. Remember, deferred income is a balance sheet item. It's actually a liability. It's kind of saying that I've been paid in advance for that tenant to be in my space next year, so I owe them that service. I owe them the occupation of the space, or let's say I was to kick them out at the beginning of the second year, I actually have to repay that £1,000, wouldn't I? So deferred income is a balance sheet item So the rental income that we're recognising the P&L is just going to be the £1,000 for the first year. Now the second tenant, well, they haven't paid me a penny of cash, so obviously I can't debit the cash account by any actual amount, but they have been in my space. I've earned the income and I'll be charging them for it next year. So what we do need to do is we do still need to recognise £1,000 of rental income for this second tenant. I have earned the income, but since they haven't paid me, well, I'm owed that money, and I will at some point be invoicing it when we get to the second year. So this is accrued income. Accrued income will be a debit, and again, this is a balance sheet ledger account, just like deferred income, but because this is on the debit side, accrued income is an asset. You can imagine the fact that that tenant has sat in my space for the first year. I may not have invoiced them yet, but they do owe me that money. It's just paperwork. It's just me getting round to sending them an invoice, and then they will at some point have to pay me for that. So remember, deferred income is a liability. Because I've been paid in advance, I owe that money back to that tenant until they've actually then had their second year's worth of occupation of my space. Accrued income is then an asset. I'm owed that money, they've been in my space, I haven't charged for it yet, but they are going to have to pay me at some point. Now if you imagine then, what's going on in the rent income T account is I have got the correct figures now recognised for my income in the first year. We're recognising 1 year's worth of income for each of the two tenants, £1,000 for each of them, even though one of them paid me for 2 years and one of them hasn't paid me a penny yet. So we are now applying our accruals concept correctly. And that's what would be going on in the first year, so that when we actually balance off our T account, or for the rental income, I would actually end up with my balancing figure of 2,000 being posted to the P&L for the period, which is correct because we had two tenants for a year at £1,000 per annum. Now that's what would happen in the first year, and I'd just like to think briefly about what would happen in the second year. Because the accrued income and deferred income are both balance sheet ledger accounts, they would be carried forward to the beginning of the second year. Remember, balance sheet T accounts are carried forward, whereas P&L T accounts like the rental income, that would be cleared off to zero. So these balance sheet accounts, they would still be sitting there at the beginning of the second year. Now let me set up, and I'll set up another cash T accounts. This is for the second year, another rental income T account. Let's think about what's going to happen in the second year. Well, for tenant 1, are they going to pay me any cash? Well, no, because they paid me the full £2,000 in the first year that related to the 2 years in total. So you can imagine tenant 1 is not paying me a penny of any extra cash, but they are still occupying my space. So actually I'm still earning income from them, they just happen to have paid for it last year. So how do we bring that into the rent income ledger account? Well, we do that by reversing the deferred income. Dealing with accrued income and deferred income is much the same as with accrued and prepaid expenses. At the beginning of the new period, you have to reverse any opening balances. Remember, on the deferred income, we've got that opening balance of £1,000 that we deferred at the end of the first year. So I now just need to reverse that entry, and to reverse deferred income you just post exactly the reverse double entry of what we used to set it up. Well, to set up the deferred income we posted a credit, so all I'm now going to do is post a debit entry. So again, this is for tenant 1, remember, so I'm now going to debit the deferred income and I can now credit rental income because I have now earned that second £1,000 worth of income. In fact, you can hopefully now see that effectively that £2,000 we were paid by tenant 1, we've spread £1,000 being recognised in the P&L for the first year, and the second £1,000 now being recognised in the P&L for the second year. So that's how we would reverse the deferred income for tenant 1. Well, what about tenant 2? Now, tenant 2 hadn't paid us a penny in the first year, so actually now they're going to be paying us the whole £2,000's worth of 2 years' worth of rent. Can I recognise that entire £2,000 as income in the second year? Well, no. Only 1 year's worth of it relates to the second year, and how are we going to account for that? Well, we account for that by reversing the accrued income. Now again, reversing accrued income, just the reverse of the entry we used to set it up. So we debited accrued income to set it up. So now we're going to credit the accrued income to get rid of it. So we credit the accrued income. Now the other side is balancing against the cash, but you can see we had a total debit to cash of 2,000. So the other side of this double entry, at the moment I've got a debit of 2,000, a credit of only 1,000 on the accrued income account. The other credit entry goes to rental income, because we are now earning £1,000 of income in the second year for the second tenant. So you can see that double entry does balance overall. We've got a debit of £2,000 on the cash account for the amount they've now paid us, but the credits are split. The first £1,000 on the credit side is reversing the accrued income from the first year, and the second £1,000 is actually being recognised as the second year's income. And again, you can hopefully see that we've now split the income for the second tenant. We recognised the first £1,000 in the first year. We hadn't actually been paid for it, but we dealt with that in the accrued income. And then the second £1,000 is now being recognised in the second year's P&L. In fact, if you look at the second year's rental income account, again, remember this is a P&L account, this would be balanced off to show income for the second year of £2,000. And again, we're recognising 1 year's income for each of the two tenants, aren't we? £1,000 for tenant 1, £1,000 for tenant 2. So again, by reversing out the accrued income and the deferred income, we've now applied the accruals concept correctly. And because we've reversed out those two balance sheet T accounts, you can see the accrued income is now emptied to nothing and the deferred income is emptied to nothing, because by the end of the second year, we're all square, aren't we? We've now been paid for 2 years by both tenants for the 2 years that we've got to. So I hope that makes a little bit of sense of how we would deal with, firstly, the accrued and the deferred income in the first year to make sure that we're recognising the correct income for each tenant, but actually then how it would be reversed in the second year to make sure we're still recognising the correct income for each tenant. Well, I hope that's been useful. Thank you very much for your attention. I'm hopefully going to chat to you again soon.